All right, I am joined now by George Goncalves of Cantor Fitzgerald to give us a little bit of color, some context here. Welcome, George.
Thanks for having me back.
Looks like the bid to cover real good, again, strong demand. What is your take on the results?
I mean, again, we're witnessing month after month stronger and stronger auctions as if there's not enough supply to go around. And it's a very telling market that, you know, when you have so much liquidity flowing through, all boats rise. And you're seeing today in the stock market, commodity markets, bond market, anything that has a price tag is going up in value.
The micro picture, though, for fixed, right? First thing that comes to mind is the Fed's wrapped up its asset purchase program. So why is the demand continuing?
Well, was it really driven by the Fed's buy program?
I guess that's the question you have to ask yourself.
And as we're seeing now, the spillover and the carryover of bond buying remaining robust tells us that the Fed really what they did was kind of grease the wheels and let the markets normalize a little bit, but yet yields stay low.
Are investors still, though, concerned? Are they doing a safety play here?
I think there's a couple different things that are going on. I mean, I think there's almost like a barbelled approach where you can be long risk assets and you can be long treasuries. And if you're wrong on one, you're right in the other. You kind of got this kind of hedge going into the end of the year. I also do believe that, you know, with tomorrow's 10-year auction and 30-year auction, a lot of folks that have been making decent profits in credit markets might actually move into the safety of treasuries at the end of the year. And tomorrow is a good opportunity to do that.
All right, so that's what we'll keep our eye open for tomorrow. In the meantime, let me ask you about the indirects coming in, again, real strong. Let's see, what was the 68.5%? I guess the last auction, which was last month of 3-year notes, was 49.2% indirect. That's a huge margin up.
That really is. I mean, that, again, is not just foreign buying, but it is usually coming from our foreign creditors. Now, close to 70% of the auction is not in the market. It's actually placed with customers. And again, given how low yields are, you would think that there would be some sort of resistance to that. But yet here we are at the end of the year with so much supply already produced and more to look for in the year ahead. And people are buying at 1.4% 3-year notes.
Should this ease our concerns about this ballooning national deficit?
Look, we shouldn't take it for granted. I think that we should be very conscious of the fact that you can't just keep issuing securities like there's no tomorrow, but there is definitely an appetite out there because there's a paucity of other alternatives in fixed income. And so long as that remains, as long as banks have less credit availability to give out to consumers, they're going to be investing into treasuries. That dynamic does not get...
What's the catalyst then? Talk more what you think is going to shut that floodgate off.
I think that, you know, look, the Fed last week gave us indications of where they would, you know, start to tweak things here and there. You know, the capital is utilization comment was really meant towards the unemployment number, and as we got on Friday, things aren't looking that great on the job front. But they're also looking at inflation expectations, and if you look at tips break-evens and inflation expectations rising at a very quick rate, you know, moving from a 0 to 25 range, which is the Fed is at right now, and just moving just to a 25 could be enough to kind of spook the markets a little bit.
But it's interesting because all the Fed officials are saying, oh, we're so comfortable with inflation right now. It's not a pervading threat, and we're going to keep rates low for an extended period, as we heard last week at the Fed meeting.
Well, there's a difference between expectations and actual real inflation. And the problem is expectations can actually become real inflation down the road. And I think right now, if you look at the metrics that the Fed's looking at, there is no inflation really outside of the commodities world. Wage pressures are down. People are not, you know, getting the same kind of salaries that they used to.
In your pre-auction commentary, the note you put out this morning, the 3-year should go over well as it is a darling among front-end players with its sub 1%. Some folks might look at the 3s as the optimal part front-end to own right now, more so than 2s, because the 2's way below 1% right now.
I think so. I mean, look, this happened in Japan. Rates kept grinding lower, and people started to move slowly out the yield curve to get more yield. And we're seeing that today.
And that's the strategy there. Okay, so we're seeing a steepening yield curve. Is that going to continue through the end of the year and early into next?
I think we'll probably slow down the steepening trend. So long as tomorrow's auction is the 10-year and the 30-year, which are the back end of the curve, if that does not steepen into the auction and actually performs well, post-auction, I think that will flatten into the end of the year.
George Goncalves, Cantor Fitzgerald, giving us the update on the Treasury market and what's going on with the auctions, what's driving the action. Appreciate it, as always, George.
Thank you.
Have a great afternoon.